Welcome back to the Microlearning Institute. In this short tutorial we're going to do a question that will illustrate the fundamental principles of IAS 2 inventories. In this question we look at the inventory of a motor vehicle dealer at the end of an accounting period, and this inventory includes the following used vehicles. Now we can see from the table that there are 4 vehicles, vehicle A, B, C and D. We can see the costs that have been incurred to date on each of these vehicles. We can also see the expected further costs before we make the sale. And then we can also see the expected selling price of each of these vehicles. Additionally, we are told that the dealer's sales staff are paid a commission when they sell a vehicle. This commission is calculated at 5% of the selling price. And the question now for us is to calculate the value at which these items should be shown in the dealer's financial statements. So firstly, let's look at vehicle A. We are told that the costs incurred on vehicle A are $14,200. To calculate the net realizable value of vehicle A, we first take the expected selling price of $18,000. Now we can only take 95% of this into the net realizable value calculation because, of course, as we're told, 5% of the selling price is going to be awarded as a commission to the sales staff. Additionally, we must deduct the $1,250 to achieve the final net realizable value. This $1,250 is the cost that must be incurred in order to prepare the vehicle for sale. Thus, the net realizable value of vehicle A is $15,850. IAS 2 tells us that items of inventory, such as vehicle A, are held on the balance sheet at the lower of cost and net realizable value. In the case of vehicle A, the lower of cost and net realizable value is $14,200. If we now proceed and perform the same calculations for vehicles B, C and D, we can see that vehicle B, the lower of cost and net realizable value, is $17,500, which is the cost of vehicle B. In the case of vehicle C, the lower of cost and net realizable value is $11,900, which is also the cost of vehicle C. In contrast, in the case of vehicle D, we can see that the lower of cost and net realizable value is $11,490, and this happens to equate to the net realizable value of vehicle D. Hence, the overall carrying amount of the inventory of this company at the balance sheet date is the sum of the individual valuations of each vehicle, totaling $55,090. Thank you for watching this illustrative IAS 2 question at the Microlearning Institute.